Ever thought about, getting a piece of the action from those huge companies you see everywhere? Not just buying their stuff, but actually owning a bit and maybe making some money when they do well.
Yeah, that's exactly what shares are all about. It's this idea of owning tiny slices of a company.
And that's what we're diving into today, shares, and this thing called dividends, how you actually get paid.
hmm We've got some notes, some articles here, basically breaking down the key terms, the calculations involved. It's about understanding how these little pieces get valued and how the profits get shared out.
So, our mission, if you like, for this deep dive is to really strip away the jargon. We want to make shares and dividends clear for you, focus on the basics, the practical side of things.
Get you comfortable with the core ideas and how it all works.
Okay, let's kick things off then. What exactly is a share, fundamentally?
Well, think about a really big company. If it wants to raise money, maybe to grow or build something new, it can divide its total value into lots. I mean, lots of small equal parts. Those parts are the shares.
And they sell these off to investors.
Exactly. Selling shares is a way to bring in capital. And if you buy a share, you own a tiny fraction of that company.
Gotcha. And each share has this sort of baseline value the company sets, the nominal value.
Precisely. Nominal value, you might also hear it called face value or register value, printed value, FV sometimes. It's the value stated on the, well, not literally paper anymore, but in the company's official records.
And that one doesn't change much.
Generally, no.
Yeah.
That's the key thing about nominal value. It's usually fixed. It's like the official starting point for that share's value.
Okay, fixed nominal value. But like we all know, share prices go up and down constantly. That's not the nominal value, right? That's the market value.
Absolutely. Market value or cash value, that's the real-time price.
Yeah.
It's what a share is actually being bought and sold for on the stock market at any given moment.
And that's the one that fluctuates.
Oh, yeah. Big time sometimes.
What drives those changes? Why does the market value bounce around?
It's a mix of things, really. Company performance is huge. Oh. Are they making profits? Growing? Losing money? That heavily influences it.
Makes sense.
Then there's investor sentiment, just what people think about the company's future. Good news, bad news, general economic climate, what's happening in that specific industry. It all feeds into the market value.
Right. And this gap, or sometimes lack of gap, between the nominal value and the market value, that leads to some specific terms, doesn't it? Like at par.
Exactly. If the market value happens to be the same as the nominal value, we say the share is trading at par. So market value equals nominal value. Yeah. Simple enough.
Okay.
But if the market's valuing it higher, maybe because the company's doing really well, then the market value is greater than the nominal value. That's called trading above par or at a premium.
A premium, right.
And the flip side, if the market value drops below the nominal value, perhaps the company's hit a rough patch. It's trading below par or at a discount. Market value is less than nominal value.
So the premium or discount is basically the market saying how much more or less it thinks the share is worth compared to that initial nominal value.
You got it. It reflects the market's current mood and assessment.
Okay, so market value is what you pay or get when you sell. But the reason a lot of people invest, beyond just hoping the price goes up, is dividends, right? Getting a share of the profits.
Precisely. A dividend is basically the company saying, hey, we made some profit and we want to share a bit of it with you, our owners. It's a direct return on your investment.
And here's a really crucial point our sources stressed. The dividend amount isn't based on that fluctuating market price you paid. It's linked back to the nominal value.
Yes, that's super important to remember. The dividend is always calculated as a percentage of the nominal value. Always.
Why is that?
Because the nominal value represents that sort of foundational slice of the company's capital that the share originally represented. The dividend rate is applied to that base value.
Okay. So let's say a share has a nominal value of, 100, and the company declares a 5% dividend.
Then the dividend you get for that share is 5% of 100, which is 0.
Even if you bought that share on the market for 150. Or maybe you got it for 80.
It doesn't matter what you paid. The dividend calculation itself starts with the nominal value, so €5 per share in that case.
Right. That's a very clear distinction. Okay, so if you're thinking about investing, you need some basic ways to calculate things. Let's start with just how much money do you need to buy the shares in the first place?
Yeah, the total investment, it's pretty straightforward. Just multiply the number of shares you want to buy by the current market value of one share.
So sum invested, number of shares, X market value per share.
Correct. And just remember, if those shares happen to be trading at par, then the market value is the same as the nominal value, but usually you'll be using the market price.
Okay. What if you know how much money you want to invest, say 10,000, and you need to figure out how many shares that gets you?
You just flip the formula around. Number of shares equal total sum invested market value of one share.
Simple division.
Yeah. And sometimes, as our notes mention, you might figure it out differently. Like if you know the total dividend you got and the dividend per share, you can work backwards. But the investment divided by market price is the main way.
All right. Now you own the shares. The company declares a dividend. How do you calculate your total payout?
Okay, the total dividend you earn is the number of shares you own times the rate of dividend the company announced times the nominal value of a single share.
Number of shares, dividend rate, percent, at nominal value. Got it.
Remember, that rate is always applied to the nominal value.
And finally, the big question for any investment. What's my return? How do I calculate that percentage?
Right, the return percentage. Or you might hear income percentage, profit percentage. It's your total income from the shares, which is usually the dividend.
Usually the dividend, yeah.
Divided by your total initial investment, what you paid for them, and then multiply that by 100 to get a percentage.
Income investment, X 100%. Standard return calculation.
Exactly. It shows how hard your invested money is actually working for you through those dividends.
Okay, great. We've got the definitions, the formulas, the building blocks. Now, let's make this real. Our sources had a ton of examples. Let's walk through some calculations, starting with just buying shares.
Sure. Okay, first scenario. Imagine you want to buy 350 shares. The nominal value is 20 per share, but they're trading at a premium of 7.
Okay, so premium means the market value is higher. 20 plus the euro premium.
Means the market value is 27 per share, so your total cost, 350 shares times 27.
Which works out too, 9,450. That's your total investment.
Precisely. Now another one, buying 275 shares. Nominal value is 60 this time, but they're trading at a discount of 10.
Discount means market value is lower, so 60 minus the euro discount.
Market value of 50 per share, so 275 shares times 50 each.
Comes to 13,750.
Yep. And sometimes it's simpler. The source just says buying 50 shares quoted at 38.50.
So the market value is 13,750.
Yeah.
No premium or discount mentioned, just the price.
Right. So 50 shares times 38.50 euro gives you 1,925 total cost.
Okay, that's the buying part. Now let's bring in the dividends. There was an example with Reki.
Ah, yes, Rocky. She invested 12,500 and she bought 200 shares at a market price of 62.50 each. The shares paid a 6% dividend.
Okay, so she bought 200 shares at 62.50. That's 200 times 62.50, which is 12,500. So her investment matches. Now the dividend is 6%, but 6% of what? We need the nominal value.
Exactly. The example helps us work backward. We're told her total income dividend was 600 from those 200 shares.
So 600 divided by 200 shares means she got 3 dividend per share.
Right. And if that euro represents 6% of the nominal value, then the nominal value must be euro divided by 0.06, which is 50.
Ah, okay. So the nominal value was 50. Let's check. 200 shares at 6% times never 50 nominal value, 200 and 0.06 by 50.
Yeah, that's 600. It works out.
Perfect. Now, how about Ramesh? He bought 600 shares, nominal value 100, but he bought them at a euro premium.
So he paid 100 plus 20. A market value was 120 per share.
Correct. So his total investment was 600 shares times 120. We were 72,000. Quite a bit. Okay. And the company declared a 15% dividend.
Right. So his annual income.
Yeah.
600 shares times the 15% rate times the which value.
So nominal value 100.
Exactly. 15% euro 100 gives him 9,000 in dividends.
9,000 income on its 72,000 investment. So what's his percentage return?
We use that formula. Income investment. Yeah. So 9,000 or 72,000, 900.
That comes out to 12.5%.
Yep, 12.5% return on his investment. Yeah. See how the dividend rate, 15% on NV, is different from his actual return percentage? 12.5% on NV because he bought at a premium.
That's a really good illustration. These examples are great for seeing how it works. There was another one about investing a lump sum, 67,200.
Right. Invested 67,200 in shares with a nominal value of 100, but they were quoted on the market at 120.
Okay, so first, how many shares did they get? That's investment market value per share. So 67,200 divided by 120.
Which equals 560 shares.
Got it. And the dividend rate was 12%.
So the total income is number of shares X, rate, and nominal value. 560 shares, 100 nominal value.
560 times 0.12 age 100. That's 6,720 in dividends.
Correct. And these examples cover different angles too, like half-yearly dividends.
Oh, yeah, that's a good point. Some companies pay out twice a year.
So one example, 250 shares in a 50 nominal value. The company declares a half-yearly dividend of 4%.
So 4% for the first half, 4% for the second half. assuming it's consistent.
Right. So the yearly dividend per share is effectively 8% of the nominal value. 8% of 50 is €1.4 per share per year.
Okay. And with 250 shares, the total annual dividend is 250 E's or 4, which is an old thousand.
Simple enough once you account for the half-yearly bit.
There was also one where you had to find the dividend rate. Someone bought 500 shares, 10 nominal value.
And they received a total dividend of 400.
So we know total dividend, no. Shares is rate X and V. We need to find the rate.
So rate, total dividend, no. Shares SNV. That's 400 divided by 500 shares at €8.
Which is €400, 5,000.
Yep, that gives big 0.08. To make it a percentage, multiply by 100.
8%. So the dividend rate was 8%.
Exactly. And then things get a bit more involved, like Mukul's case. He invested, got dividends, and then sold some shares.
Right. He invested 9,000. Shares had 100 nominal value, but he bought them when the market value was 150.
Okay, first step. How many shares did he buy? 9,000 investment divided by 150 market price per share.
That's 60 shares.
Correct. The dividend rate was 6%, so his annual income. 60 shares x 6% time 100 in nominal value.
60 ACE, 0.06 ACE is 360 per year.
But then he sold half his shares, so 30 shares, and he sold them when the market price had gone up to 200 each.
Wow, nice timing. So he sold 30 shares at 200. That's 6,000 he got back.
Yeah. Now, what did he pay for those 30 shares he sold? He bought them at 150 each.
So he paid 3,850 equals 4,500 for them originally.
Right. So his gain, his profit just from selling those shares, is the selling price minus the buying price for its €6,000, 4,500.
1,500 profit on the sale. Plus, he still had the dividends he earned before selling.
Exactly. It shows you can profit from both dividends and changes in market value.
Okay, let's see. Another scenario involves someone wanting to increase their income.
Yeah. This person wanted to buy 62 shares. Nominal value 100, market value 132.
So the investment needed is 62 shares, 832 market value, 8,184.
Right. And the dividend was 7.5%. So the annual income from these 62 shares would be 62A 7.5%, a under nominal value.
62 as 0.075, 500 in R2 equals arrows 465 per year.
But then they decide they want to increase that annual income by another 150. How many extra shares do they need to buy?
Okay, well, we know each share gives 7.5% of 100, which is 7.50 in income per year.
Exactly. So to get an extra 150 income, you divide that target by the income per share. 150, 7.50 per share.
That means they need 20 extra shares.
Yep. They need to buy 20 more shares to boost their income by that desired 150.
Interesting. And there was one from the company's perspective, too.
Yeah, a company with 4,000 shares issued, 110 nominal value each. They declare a 15% dividend.
So the total amount the company pays out in dividends is 4,000 shares, actually 15%, 910 nominal value.
Which comes to $66,000. That's the total dividend pool.
And then it looked at one specific shareholder, Shahrukh, who holds 88 of those shares.
Right. So his share of that dividend pool is just his 88 shares, 15% of your 110 nominal value.
Which works out to 1,452 for him.
But then it added a twist. What if Shahrukh said he actually received a 10% return on his investment? What price must he have paid for each share?
Ooh, okay. So we know his income per share is 15% of 110 MAI, which is 16.50.
Right. And we're told this euro 16.50 income represents a 10% return on whatever price, let's call it P, he paid. So 16.50.1 euro.
Or 16.50 equals 0.10 AP, so P equals 16.50.10.
Okay, but he must have paid 165 ROFR per share. That was the market value when he bought them to get that 10% return.
Clever. Working backwards from the return percentage.
Yeah, these examples really test your understanding from different angles, like finding the purchase price needed for a specific profit percentage.
Let's see, buying an 80 nominal value share. Dividend is 20%. Yeah. You want a 16% profit on your investment. What should you pay?
Okay, first, what's the dividend income per share? 20% of 80 NAV is 16.
Right. Now, you want the 16 income to be equal to 16% of the price you pay. Let's call it P again.
So 16% of P, or E16 is 0.16 E.
So P equals 16 euro 0.16, which equals a 1 should.
So you should be willing to pay up to 100 market price for that share to achieve your target 16% return.
Makes sense. Then there was Ajay's example. Owned 560 shares, 9% air, 9% dividend.
First part, calculate his total dividend. 560 shares at 9% times euro era.
560 euro 0.09 times 25 area equals 12,260.
Right. Then we're told he paid 0 for 30 per share. That's the market value you bought at. What's the actual rate of interest or return on that investment?
Okay, his income per share is 9% of 25 NV, which is 2.25. He paid 30 per share.
So his return percentage is income per share, investment per share, ec 100. That's 2.25 euro by 100.
That comes out to 7.5%.
Exactly. Even though the dividend rate was 9%, his actual return on the money he invested was 7.5% because he bought above the nominal value.
These calculations are really hammering home that NV-MV difference. What about investing to get a specific income?
Yeah, like shares with 80 MV, selling currently at 75 MV, so at a discount.
Yeah.
Dividend rate is 15%. You want an annual income of 1,080.
Okay, first, income per share. 15% of 80 MV is 12.
Right. To get a total income of 1,080, how many shares do you need? 80 euro, 80 total income, 12 income per share.
You need 90 shares.
Correct. And since they are selling at 75 MV each, the total investment needed is 90 shares, 875.
6,750.
That's the investment required for that target income.
Okay, another one, linked return rate and market value. A 9% dividend on a 100 NV share gives a 7.5% return on investment. What was the market value it was bought at?
All right, the income per share is 9% of 100 NV, which is 9.
And we know this Euro 9 income represents a 7.5% return on the market value MV paid. So €9, 7.5% of every...
Well, 9 euro, 0.075 MV. So MV 0, 9.075.
Which is 120. So the market value must have been 120?
Yep. And then it asked, how much would you need to invest in these shares at 120 MV to get an annual dividend of 630?
We know the dividend per share is 9. So to get 630 total, you need €630 9 per share.
70 shares.
And the investment for 70 shares at 120 MB each is €70 120.
8,400.
Got it. We're really covering a lot of ground here. There was also comparing two different investments.
Right. Always useful. Option 1, 12% dividend on 100 MV shares selling at 120 MV.
Okay. Income per share is 12% of euro 100, euro 12. Investment per share is 120. Return percent is €12 on 120. On 100 is 10%.
Option 2, 8% dividend on 100 NV shares selling at 90 euro.
Income per share is 8% of euro 8. Investment per share is 90. Return percent is €8 s 100. That's about 8.89% or 8.9%.
So comparing the returns, 10% versus 8.9%.
Option 1 looks like the better investment based purely on percentage return.
Based on that metric, yes. Then there was a more complex one about selling shares and reinvesting the money.
Oh yeah, tracking the change in income. Someone sells 60 shares, NV euro 15. Dividend rate 12%, sells them when MV is 21.
Okay, first, what was their initial income from these 60 shares? 60 shares x 12%, F's 15 NV.
60x 0.12 as 15, that was their starting income.
Now, they sell these 60 shares at 21 each. Proceeds from sale is 60 euros 21 equals 21 euros 60.
Right. Then they take this 1,260 and invest it in different shares. These new shares have 6 NV, are selling at 9 MV, and pay an 8% dividend.
Okay, how many new shares can they buy with 12,260? Number of new shares? 160 euros 9 MV per share.
That's 140 new shares.
Correct. Now, what's the income from these 140 new shares? 140 shares at 8% dividend at, say, Z6.
140 at 0.08 times 6. This is their new annual income.
So what's the change in income? They started at 108, now they get 67.20.
That's a decrease. 108 euro, 67.20 equals 40.80 less income per year.
Exactly. Selling and reinvesting change their income stream. Sometimes it goes up, sometimes down.
Okay, just a couple more complex ones. Mr. Ramgopal invested 8,000 in 7% shares, 100 NV, but bought them at 80 MV.
First, how many shares? 8,000 investment euro 80 MV per share equals 100 shares.
Okay, first year dividend, 100 shares, 7%, 100 MV equals 700.
Right. Then after a year, he sells these 100 shares when the price is 75 MV. So 108 euros, 75 euro on 500 from the sale.
But it says he reinvested the proceeds, including the dividend.
Ah, good catch. So total money to reinvest is 7,500 from sale plus 700 dividend, equal to 8,200.
He invests this 8,200 in new shares, 18% dividend, 45 MV selling at 41 MV. How many new shares?
8,200 euro, 41 MV per share equals 200 new shares.
And the income from these new shares in the second year, 200 shares, 18% on or euro MV.
200 is 0.18, 25 euro, 900.
So his income went from 700 in year 1 to 900 in year 2. The question asked for the percentage increase in return on his original investment.
Original investment was 8,000 a day. The increase in income was 900 euro, 700 euro, 200.
So the percentage increase in return is increase in income original investment. X 100, that's 200 euro, 8,000, 8,700.
Which comes out to 2.5%.
Okay, that tracks the change relative to the initial outlay. Then Ashok and Sandeep, who invested the same amount but in different shares and got the same dividend amount.
Right. Ashok invests 18,000 in 7.5% shares, 100 NV, bought at a 20% discount.
20% discount on 100 NV means MV was 80. Number of shares Ashok bought at 18,000 euro and 80 euros, 225 shares.
Ashok's total dividend equal 225 shares, 87.5%, as 180 euro equals 687.50.
Okay. Now, Sandeep also invested 18,000. He bought shares with 50 NVE at a 20% premium.
20% premium on 50 MV means MV was 50 plus 20% of each, plus current plus 10%.
Its number of shares Sandeep bought, 18,000 euros, 60 MV equals 300 shares.
And we're told Sandeep received the same total dividend as Ashok, which was 1,687.50. We need to find Sandeep's dividend rate.
Okay, we know Sandeep's total dividend, no, shares, X rate, X or NV. So 687.50 euro eats 300 shares, X, rate X, 50 MV.
Rearranging that. Rate, 1,687.50 euros, 1,687.50 thousand, will $15,000.50.
Which equals 0.1125 as a percentage.
11.25%. That was the dividend rate Sandeep's shares paid.
Wow, okay. Last big one, John's transactions, finding the number of shares sold based on income change. This looks tricky.
It combines several steps. John initially owned 1,000 shares, 40 NV, paying 8% dividend.
Initial income equals 1,000 shares, X percent, 40 NV equals in 3,200.
Right. Then he sells some shares, let's call the number sold X, at a 10% discount.
10% discount on 40 NV means selling MV was 36. Money from selling X shares equals 36.
He takes this 36X and invests it in new shares, 20 NV, selling at 50% premium.
50% premium on 20 NV means new MV is 20 plus 50% of euros owe 30.
Number of new shares bought, money invested MV per new share equals 36 by 30, equals 1.2x shares.
Okay, these new shares pay 12% dividend. Income from new shares equals 1.2x shares x 12% on 20 NV.
1.2x times I.12x at 20, S is 2.88x. That's the income from the new investor.
You know, what about the shares he didn't sell? He started with 1,000, sold X, so he has 1,000X original shares left.
And the income from those remaining original shares is on 1,000X shares X 8%, on 40 NV equal 1,000X X 3.2.
So his new total income is the sum of income from remaining old shares and income from new shares. 1,000X, 3.2 plus 2.88F.
Okay, deep breath. We are told his overall income increased by 192. So new total income, old total income, 192.
Right. So 1,000X, 3.2 plus 2.88 by 3,200 equals 192.
Let's expand that bracket. 3,200, 3.2x plus 2.88 by 3,200 by 3,200. The 3,200s cancel out, so net of 3.2x plus 2.88x equals 192. That simplifies to net of 0.32x equals 192. Now solve for x. X equals 192. Then register 0.32. Wait, it gives a negative number. Let me recheck the setup. If income increased, the change should be positive. Let's reread the equation logic. New income. 3,200, 3.2x plus 2.88x. Change, new ergo, goes 3,200.32x, 3,200.32x, 3,200, right, level 0.32x. If income increased by 192, maybe the source meant the change was plus 192. Let me reread the source description. Wait. Example 18 says, change in income is 192. It doesn't specify increase or decrease. Let's reread my calculation. Wait. 1,000 by 3.2 plus 2.8x plus 3,200 plus 192. 22 equals 392. So 3,200, 3.2x plus 2.88x plus 392, 392, 3,292, or 9,600. That can't be right. Number of shares can't be negative. Let me assume the income decreased by 192. Then 3,200.32x, 3,200.32x plays near to 92x. The integer 192 equals negative 192x equals 600. Okay, that makes sense. The source outline might have been ambiguous about increase, decrease, but a decrease leads to a plausible answer.
Okay, so assuming the income decreased by 192, then X 600 shares sold. That was complex.
Yeah, that really pulls everything together. Selling, reinvesting, calculating income changes. It shows how dynamic this can be.
Phew. Okay, that covers the examples. It really demonstrates how understanding nominal value for dividends and market value for buying, selling, and calculating overall returns is just fundamental.
Absolutely. And, just a necessary reminder for everyone listening, these examples, all these numbers and companies, they're purely illustrative. They're just tools to help you grasp the mechanics.
Right. This is an advice, definitely not a recommendation to buy or sell anything specific. It's about understanding the concepts.
Exactly. Always do your own homework. Think about your own financial situation, your goals, how much risk you're okay with before making any actual investment decisions.
So let's wrap this up. We've really dug into shares, those units of ownership, and the two key values. Nominal value, the fixed base for dividends.
And market value, the fluctuating price you actually trade at, influenced by company performance and investor feelings.
And we've looked at dividends, the company sharing profits with you, the owner, calculated off that nominal value.
Plus, we've gone through the essential formulas, calculating your investment, number of shares, dividend income, and crucially, your percentage return. Getting these basics down is so important if you're interested in the stock market at all.
It really is. So here's something to think about now that you've got this foundation. What kinds of companies, maybe industries, might you find interesting to look into more? And based on what we talked about today, nominal value, market value, dividends, potential for growth, what factors would you now really focus on when considering whether investing in a particular company makes sense for you? It's all about weighing that potential reward against the risk, isn't it?